Well, a very good day to all of you. Today, Indorama Ventures reported its first quarter result for the year of 2023. Today, we're joined by Indorama Ventures CEO, Mr. DK Agarwal, to discuss the key points of that result. And a very good day to you, sir.
Thanks, Stuart, for having me.
So just to kick off, Mr. Agarwal, in Q4, we reported that a number of unprecedented headwinds had weighed on our result. Those headwinds included obviously peak energy costs, especially in Europe, and also the unprecedented levels of customer destocking. Has that situation eased somewhat?
Yeah, so that destocking is still continuing, but the headwinds has eased out. Our operating rates improved, 5% volumes increased, but they are not normalized at present. They are still 8% below the same period last year. But we are seeing a positive signs as we move to the second quarter. Combined PAT, I think we'll get back to the normal volumes. IOD is still the crop solutions. There is a destocking happening because of glyphosate inventory. Fiber is coming back. So overall, the signs are looking positive. Remember that China opening first quarter didn't have impact. The service sector is basically having more impact right now as the Chinese are traveling. But as the manufacturing comes back from China and the predicted second quarter growth of 7.5% in China, we are optimistic about the volumes as we go forward. And remember, 70% of our volumes are daily necessity, and that is not related to the construction, and 30% is what is durable goods.
And is it too early to call this a recovery from those peaks, or is this going to be a slow and gradual normalization through the rest of this year, or sooner than that?
I think it will be slower. It won't be a rapid V type of recovery. It all depends on how China opens up. There are certain positive signs which are developing. US economy is still doing great. Fed has increased 25 basis points. The unemployment data is good. In Europe, the utility prices have come down. We got a $48 million saving net of losses in the energy versus last quarter. Overall, this year to 2023, we expect a saving of about $180 million. Although I'm not about Europe because of the geopolitical situation, Europe will be still in a recessionary situation. So our focus has been how to control the cost, be cost competitive, also look at the innovation and the Asia of transferring the products from Europe and United States. So that is the focus, and we are very focused on our Olympus program, which continues to deliver a 464 million run rate. And I think this is the need of the timing now.
Okay. Mr. Agarwal, if you have a look at various broker reports, certainly in recent weeks and months, a lot of these brokers have been recommending our stock. What do you think makes us an attractive investment for investors at the moment?
Yeah, the analysts are recommending a buy. Naturally, there are few fundamentals behind it. Our resiliency of earning and the cash flow is very predictable. As I mentioned, 70% of our products are daily necessity. People don't cut on daily necessity. They do cut on the discretionary spending. That's one positive. Second, we are a growth mindset. We did 2 large major acquisitions which has performed very well, Oxiteno and Huntsman. The third is we are in the sustainable products because we are delivering the products which are good for future climate. And there is the inclination to buy those sustainable products. We have very geographical diversified footprint, which acts as a perfect hedge when the customers are looking for local solutions. So these are all positive points, and the interest costs are going up. 61% of my debt is at the fixed interest rate. That helps me and not makes me vulnerable to the high interest rate environment.
Well, Mr. Agarwal, thank you very much. I wish you all the very best for Q2 and the year ahead.
Thank you. Thank you very much.